people are now using AI to build the AI, to build the business, to build the AI. And it's like hyper fast. I'm worried that venture capital will never be able to capture money in this environment. Sure, in some areas, of course, but in some of the really fast moving areas, we've seen it in blockchain. It's been really hard. It's an ICO market seems to be more effective because it can trade for 6 months and be worth a lot or nothing. And it's okay. But I'm not sure the VC survives this. Businesses start and fail much faster because everybody's got this ludicrously fast technology. And we're seeing businesses using the AI to scale their business models, developing product, writing code, and it gets faster and faster and faster. It's bloody hard.
In recent years, the rapid advancement of artificial intelligence has brought about significant changes across various industries. The increase in investment in artificial intelligence from financial and other industries suggests that priorities are changing. According to the International Data Corps, sales of AI-related software, hardware, and services are projected to increase significantly, reaching $166 billion this year and surpassing $400 billion by 2027. Notably, the financial sector's spending on AI is expected to more than double by 2027, with a compound annual growth rate of 29%, the highest among major industries. Hedge funds are increasingly adopting generative AI, with nearly half of them utilizing ChatGPT for professional purposes, often for tasks like marketing text generation and report summarization. Investment firms such as Amundi SA, Europe's largest investment company managing €2 trillion in assets, are exploring AI's potential across various business lines. Amundi utilizes AI to personalize portfolios for its vast client base, incorporating real-time sentiment analysis and risk preferences to tailor investment strategies. All of these seem to be potentially beneficial. However, beneath the surface of progress lies a looming sense of risk and uncertainty. Despite the seemingly convenient qualities that this new technology provides us, AI might just be a huge threat that is destroying the financial markets, including crypto. In a global macro podcast, expert financial analyst Raoul discusses the rapid evolution of businesses due to the widespread adoption of artificial intelligence. Pal expresses concern that this swift pace poses a serious challenge for traditional venture capital models, especially in fast-moving sectors like blockchain. Let's take a look at clips from Raoul as he brings to light the issue affecting the markets that many people may have overlooked.
One of the things I've also been trying to get my head around is I also think businesses will rise and fall much faster. Like, I was using recently Otter AI to do, when you're on a Zoom call, it transcribes it, gives you some notes. Zoom, we started using the Zoom one, it's like 10x better. That's the end of Otter. And we're seeing this happen at a scale because people are now using AI to build the AI, to build the business, to build the AI. And it's like hyper fast. I'm worried that venture capital will never be able to capture money in this environment. Sure, in some areas, of course, but in some of the really fast moving areas, we've seen it in blockchain. It's been really hard. An ICO market seems to be more effective because it can trade for 6 months and be worth a lot or nothing. And it's okay. But I'm not sure the VC survives this. These platforms like Amazon, Twitter, Apple, all of these, they are now a feudal-based system. They're not capitalist because it's all rent-taking. So you're a rent taker at the middle of the system. And if you want to operate in that world, the feudal landlord takes his fees. And I think it's the same in tech hardware. That's where it's going, is like, there's literally the barriers to entry are so high, it's almost impossible, of which Taiwan as a country has a barrier to entry so high, it's almost impossible to deal with, that they become feudal landlords of the hardware. It becomes very interesting, and maybe the serfs in the bazaar trading things are all of the software companies in the end, when it used to be a software-owned world. There's something shifting here, and I don't know what it is. It feels that AI has zero moat in a world where it's kind of like a perfect competition marketplace where you're restricted by the hardware, and they all tell you that. The hardwares are constrained, and everybody's just going to build model after model after model, cheaper, faster. And AI is going to be the water of society. It's going to be everywhere, and it's going to be virtually free, I'm guessing. Mm-hmm. I don't even know what the hell that means. Businesses start and fail much faster because everybody's got this ludicrously fast technology. And we're seeing businesses using the AI to scale their business models, developing product, writing code, and it gets faster and faster and faster. It's bloody hard.
The rise of artificial intelligence is currently raising questions about how it affects different industries, especially finance. In finance, AI has changed how we invest, with more people using passive investment vehicles instead of traditionally relying on expert advisory services. The finance industry has also started to favor quick, computer-driven strategies over slower, traditional methods in areas like hedge funds. But not everything in finance changes quickly, as certain functions such as advisory services and lending continue to rely heavily on human expertise. In other words, AI's impact depends on the industry and how much data is available. Big companies with lots of resources often benefit most from AI, leaving smaller players struggling to keep up. But while AI can make many tasks easier, like investing, it might also overlook important factors that humans consider. So, while AI is powerful, it's important to remember that human judgment still plays an important role in success. Now, let's take a look at more clips of Raoul as he discusses the current business cycle conditions and the shift towards equity-driven financing and reduced reliance on traditional banks.
Right now is where I think the business cycle sweet spot lies, which is growth recovers, inflation remains low, and it starts supercharging my secular themes, which are technology and crypto. Both benefit from debasement of currency, the added liquidity, but in addition, there is this exponential age of technology that's playing out, and the adoption effects of that, of which probably AI is the fastest, but it may not be. Who knows what else is coming? There's a lot coming. The robots are coming fast as well. We've got lots going on there. And then crypto, which is actually part of the same thesis, has been on fire as we've got, the ETF flows driving things. But really what that all about is adoption. So we've got new technology adoption, which has been growing in a secular trend. And then it gets exponential every time you add the business cycle to it. So I'm really, really hyper-focused on that. If I look at, and just to tie in something Angus has looked at as well, I've gone through kind of every market versus debasement, this dividing things by the Fed balance sheet. I think Jordi and Angus, I've shown you this before. You divide it by the Fed balance sheet. There's only one emerging market that actually comes out to be growing, which is, again, on the same basis of debt demographics and deflation, is India. So you've got, a very limited emerging market set that's really working, and a very limited set. But those three markets alone are giving you enormous returns. So I'm super focused on that. People don't value businesses correctly anymore. And Jordi's right that, let's say, the business cycle is structurally shifted. That sounds like it's going to be an extremely positive backdrop for markets that most people don't understand. Last year was a typical market where nobody understood what had happened. But really what you're talking about here is kind of a change in how people approach markets and economies, and people haven't got to that understanding yet. So maybe that's one of the reasons the markets were so ludicrously strong last year. You just need the Fed to take its foot off the neck of the market, and before you know it, this kind of beach ball shoots out from underwater, because things have changed. We grew up in a world where businesses were financed by debt. The General Electrics of this world and all of these, they were debt financed businesses, and interest mattered. Basically, the entire leadership of the S&P 500 has never had a single debt in its life. Or if it does, it's just for cash flow management purposes. And they're all equity driven. Everything is equity driven now. If you think of, all of the VC business, that used to be your local bank. You'd have to beg and say, I'm setting up a new business. Now we call it a startup, and a startup actually means equity funded thing. And therefore, maybe the business cycle matters less.
The rise of generative AI tools has sparked significant investor interest, especially seen in the sharp rise of stock prices for top AI software and semiconductor firms like NVIDIA, Meta, and C3.ai. Since the introduction of OpenAI's ChatGPT in November 2022, these firms have witnessed unprecedented rallies, with stock prices surging by over 100%. This surge in AI-related stocks has prompted comparisons to the dot-com bubble of 2000. driven by worries about speculative excess, similar to the hype around internet stocks in the late 1990s. Notably, the limited number of S&P 500 stocks surpassing the index highlights the possibility of an AI-driven stock market bubble. Although Europe's stock markets might see modest gains due to the scarcity of major technology companies like ASML and SAP, the US market remains susceptible to an AI bubble, reminiscent of the dot-com era. Despite the possibility of an eventual correction, experts anticipate the AI revolution to persist. Moreover, the transformative potential of AI across various industries suggests a sustained impact, irrespective of short-term market fluctuations. Meanwhile, in a recent address at Yale Law School, SEC Chairman Gary Gensler issued a stern warning to companies regarding the deceptive practice of AI washing, a term inspired by the concept of greenwashing, wherein companies mislead investors about their use of artificial intelligence to gain a competitive edge. Gensler emphasized the importance of honesty and transparency in company advertising and marketing materials, particularly concerning their AI capabilities, cautioning against exaggerating or fabricating the use of AI to attract investors. He noted a significant increase in AI disclosures made by SEC registrants in recent years, indicating a growing trend of companies leveraging the buzz around AI. However, Gensler warned that such practices could lead to violations of SEC rules, emphasizing the need for companies to be truthful about their use of AI and associated risks, and cautioning against misleading the public by falsely claiming the use of AI models or misrepresenting how they are being used. The implications of AI washing are far-reaching, particularly for the financial industry, as AI continues to revolutionize various aspects of finance. Gensler's warning serves as a reminder for companies to maintain transparency and honesty in their AI claims and underscores the need for investors to exercise due diligence when evaluating a company's AI capabilities. In other news, the Financial Stability Oversight Council recently designated artificial intelligence as an emerging vulnerability, signaling a shift in focus toward the potential risks associated with its widespread adoption. While AI holds promise for innovation and efficiency in financial services, FSOC's annual report underscores the need for cautious implementation and oversight to mitigate risks. Among the concerns raised are cybersecurity threats, compliance challenges, and privacy issues stemming from the use of AI, particularly advanced models like ChatGPT. The opaque nature of some AI systems, often referred to as black boxes, poses additional challenges, making it difficult to assess their reliability and suitability. The FSOC emphasizes the importance of addressing biases and inaccuracies inherent in AI models, which could lead to unfair practices in areas like lending and consumer protection. As AI continues to gain traction in the financial industry, the FSOC reminds us of the importance of vigilance and proactive measures to ensure the responsible development and deployment of AI technologies. What do you think about the potential risks and benefits AI brings to finance? Are you concerned about the challenges it may pose, or are you more excited about the possibilities for innovation and efficiency? And what about regulatory oversight? Do you believe regulators are effectively addressing these concerns? Or do you think more needs to be done to ensure the responsible development and deployment of AI technologies in finance? Share your thoughts in the comments below. If you found this video helpful, don't forget to give it a like, share it with others, and subscribe to our channel for more valuable information on the new digital world of finance. Keeping yourself informed is key to safeguarding your investments. Until next time, happy investing, and see you soon.